Hypothesis testing basics introduces the statistical framework used to evaluate claims and make decisions based on sample data. In finance, analysts frequently test assumptions about returns, economic indicators, portfolio performance, and market behavior. Hypothesis testing provides a structured method for determining whether observed sample evidence supports or rejects a particular claim about a population parameter. The topic emphasizes that statistical inference allows analysts to draw conclusions under uncertainty while controlling the risk of incorrect decisions. Understanding hypothesis testing is essential for financial research, portfolio analysis, economic forecasting, and investment decision-making because it transforms data into objective and measurable evidence for analytical conclusions. The topic begins by defining the null hypothesis and the alternative hypothesis. The null hypothesis represents the default assumption or claim that analysts seek to test, while the alternative hypothesis reflects the competing claims supported if sufficient evidence exists. Hypothesis tests may be one-tailed or two-tailed, depending on whether the alternative specifies direction. For example, analysts may test whether a portfolio manager outperforms a benchmark or whether inflation exceeds a target level. The topic explains that hypothesis testing does not prove a hypothesis true or false absolutely. Instead, it evaluates whether available sample evidence is strong enough to reject the null hypothesis with a specified degree of confidence. A central concept in the topic is statistical significance, which measures the likelihood that observed sample results occurred purely by chance. Analysts calculate a test statistic from sample data and compare it to a critical value or evaluate its p-value relative to a chosen significance level. The significance level, commonly denoted alpha, represents the probability of incorrectly rejecting a true null hypothesis. Financial analysts frequently use significance levels such as 5% or 1% to control decision risk. The topic emphasizes that stronger evidence against the null hypothesis results in smaller p-values and increases the likelihood of rejecting the null in favor of the alternative hypothesis. The topic also explains type 1 and type 2 errors, which are key risks in hypothesis testing. A type 1 error occurs when analysts incorrectly reject a true null hypothesis, while a type 2 error occurs when they fail to reject a false null hypothesis. Reducing one type of error often increases the probability of the other, creating a trade-off in statistical decision-making. The significance level determines the probability of a type 1 error, whereas statistical power relates to the probability of correctly rejecting a false null hypothesis. Understanding these errors is critical because incorrect conclusions in financial analysis can lead to poor investment decisions and misinterpretation of market conditions. Another important topic in the topic is the power of a hypothesis test. Statistical power measures the probability of correctly rejecting the null hypothesis when it is false. Higher power indicates a more effective test and reduces the likelihood of type 2 errors. Factors affecting power include sample size, significance level, population variability, and the true difference between hypothesized and actual parameter values. Larger sample sizes generally improve statistical power because they reduce estimation uncertainty. In investment research, high-powered tests are desirable because they increase the reliability of conclusions about portfolio performance, asset pricing relationships, and economic trends. The key concepts from topic establish the foundation for statistical inference and evidence-based financial analysis. Hypothesis testing enables analysts to evaluate claims objectively using sample data while quantifying uncertainty and decision risk. Concepts such as null and alternative hypotheses, significance levels, p-values, type 1 and type 2 errors, and statistical power provide essential tools for interpreting financial research results. These principles support more advanced quantitative techniques throughout the CFA program, including regression analysis, portfolio evaluation, and econometric modeling. Mastery of hypothesis testing basics allows investment professionals to assess financial evidence rigorously and make more informed analytical and investment decisions under uncertainty.